Hey everyone and welcome back to the channel. My name is Hamish Hodder and in today's video we're going to be having a look at the fourth quarter and full year earnings for Monster Beverage. Now Monster Beverage is a company that I've personally been looking into for the past few months. I think it's a really interesting company. Their numbers have been outstanding and they clearly have some kind of competitive advantage over some of the other companies in its industry. So it is a very interesting company. And today I'm excited to share with you the latest earnings, that being the fourth quarter of 2018 and the full year earnings for 2018, and sort of share with you my thoughts on those results. And they also had their conference call where the CEO and the CFO answered some questions from analysts and other financial people. And there were some key takeaways that I had from that I'm excited to share with you as well. And lastly, in this video, we always do an updated valuation. So let's enter in the new numbers into our spreadsheet and we can see how the growth has been with the updated numbers over the past 10 years and more recently. And we can also come to a valuation and see, based on different growth rates, what return could we make on this stock at the current price and if we paid a little bit less. So that's what you've got to look forward to in today's video. Of course, if you have any thoughts or things you want to share about this company or even other companies in the beverage industry, then make sure you leave them down in the comments section below. One of my favorite things to do is after I publish a video, I like to respond and have a conversation with some of you about these businesses and talk about their strengths and weaknesses. So if you have any thoughts, make sure you leave them down there. I love having a discussion with you guys. Of course, if you're new around here and you want to see more content like this regularly in your subscription box, then hit that subscribe button and hit that notification bell so you don't miss out on any of the future notifications. But let's get into it. All right, so I thought we'd start by just going through the fourth quarter 2018 numbers, and then we can jump into the full year and see how they've performed over the entire 2018. So in terms of the fourth quarter for 2018, Monster Beverage had revenue of $924.2 million, which is up 14.1% year over year. And this number is pretty well in line with their long-term growth, which has been about 14% in terms of revenue. So that's good to see that they've maintained a consistent rate for their revenue growth. Then we can have a look at earnings per share. So EPS came in for the quarter for Monster Beverage at 43 cents, which was up 23% year over year. And again, this is in line with their long-term EPS growth. So their EPS growth has been pretty much between 20 and 22% fairly consistently over the last 10 years, which is another good sign that they're able to grow their top line, which is their revenue, very consistently. And they're also able to grow their bottom line, their net income or their earnings per share on a per share basis, very, very consistently. That is an excellent thing to see. In terms of equity, we won't look at equity over one quarter because that doesn't really tell us anything. So we will look at that over the full year when we get into the full year numbers in just a second. And in terms of cash flow, we actually don't have a cash flow statement from Monster Beverage as of yet. They've just released their press release, which had their financial highlights and it had their income statement and their balance sheet, but we do not currently have their cash flow statement. So we will have to wait for that one to come out a little bit later. So then we can have a look at the full year numbers, and these will tell us a better picture of the performance of this company, because of course, if we're just looking at quarter to quarter, it really doesn't tell us too much about the performance of the business, and even a single year doesn't tell us too much, but at least it's a longer period that includes all of the different seasons and all of the different cycles that happen within a year. So let's start by looking at revenue. In terms of revenue for Monster Beverage, it came in at $3.8 billion, which was up 13% year over year. And again, this is perfectly in line with their long-term growth. So they had 14% for the quarter, they had 13% over the year, and in terms of their 10-year average, it's been 14.3%. So all of those numbers are very, very consistent, and that is an excellent sign if you are a shareholder, because it means it's easy to predict what they're going to do in the next quarter because they've been doing it consistently every single quarter for the past 10 years. Then we have EPS, which came in at $1.76, and this was up 24% year over year. Again, very much in line with their long-term performance. Their long-term EPS growth has been 19%, so just below what their current is. But that means that they've been growing at 19% over the long term, which is excellent. And it also means that they've been slowly ramping it up. And this year they they were able to grow at 24%, which is a really, really strong growth rate for a company of its size. Then we have equity for the year. So here we're looking at the change in equity from the end of 2017 till the end of 2018. So as of the end of 2018, equity for Monster Beverage was $3.6 billion. And this was actually down 7.3%. So immediately you might think that that's a really bad sign because in terms of real numbers, their equity was down about 300 million over the year. However, there is a pretty valid explanation for it, and you can justify a lowering equity that is actually a good thing in some circumstances. So the primary reason why equity for Monster Beverage went down throughout 2018 was mainly due to their repurchase program, their stock repurchase program. And in the fourth quarter alone, when their stock was down a little bit, they bought back over $500 million worth of stock at an average price of $57 per share. So you might think that a declining equity is a bad thing, but it really depends what they're spending that money on. And if you buy stock above book value, so they paid $57 per share, I don't know what their book value per share is, but it is definitely below $57 per share. So every share that they bought back, they reduced the amount of equity for the whole company, and they reduced the amount of equity per share. However, if $57 per share for Monster Beverage is below intrinsic value, so if you think that their intrinsic value is above $57 per share, that means that every stock or every share that they repurchase at $57 would have added to your intrinsic value per share. So it increases the value of the shares that you hold. I spoke about this a little bit in my Warren Buffett video that came out last week. And essentially he speaks about it in his letter to the shareholders about when he's buying back stock. And he says that in some circumstances, if you're buying back stock, equity or book value will be coming down while intrinsic value per share goes up. And it's in that circumstance where equity really doesn't tell you much about the value being returned to the shareholder, because the real value returned to the shareholder is the intrinsic value per share. So whether or not this is a good or bad decision will ultimately come down to your calculations of how much Monster Beverage is worth. So that brings us to the conference call, and there was just a couple of things I wanted to mention here. There was nothing particularly outstanding. The first thing was that Monster is continuing to increase the prices of their Monster energy drinks, and that is to be sort of bring their price up closer to one of their competitors, which is Red Bull. And the response from Red Bull was to put a lot of money into advertising, and they launched a massive advertising campaign. And Monster, there was a couple of questions about this, and the CEO essentially said that that campaign has had no effect on Monster's sales, and they're going to have to slow down that campaign, because if they're spending so much on advertising, it's eventually going to hurt their profit margin, and they're just going to end it because it's really not having any effect on the Monster beverage business. And the interesting thing here, and the most important takeaway here, is that Monster Beverage is able to consistently increase the price of their products while also selling more in terms of volume. So that tells us that people are willing to pay more for that specific product. If the price was risen and then the volume fell, that would indicate that people no longer want to pay for that because they can buy a cheaper alternative. The fact that they're willing to pay more just to get specifically Monster Beverage drinks tells us that they do have some kind of an economic moat. And of course, that is exactly what we're looking for as a long-term investor. The other interesting thing was that someone asked about margins, and they asked about guidance going forward into 2019 about their profit margins. Now, the CEO essentially said that they don't do guidance on margins, but then he went on to say a bunch of things that essentially indicated that he was basically saying that margins are going to get better, which means that they're going to be keeping more of their revenue as profit in 2019. And a couple of the things that he mentioned that sort of suggested this was that aluminium prices are going to come down significantly. So due to the tariffs and other things, last year aluminium prices went up a lot for a lot of companies. It affected companies that I own, like Thor Industries, which makes caravans, and it affected companies like Monster Beverage, which use aluminium in their beverage cans. And these prices are going to be coming down, which means that there's less costs associated with that material. And the other thing is that Monster is launching a number of different products that have higher margins than their other products. So the introduction of those products will increase their margins. And the CEO heavily suggested that margins will be increasing, although he said the company doesn't guide, so he couldn't officially come out and say, yes, our margins are going to be better. But I thought that was really interesting what he said there. So it is an indication that their EPS growth in 2019 could be a lot better than it was in 2018. So let's now quickly talk about the stock price, because ultimately, if you want to be an investor, you have to pay the stock price, and then you also have to sell it at another price sometime in the future in order to make a profit. So in terms of the stock price, the stock is down about 7% for the year, but it's really fluctuated between $50 and $60 per share a number of times throughout the year. So it really hasn't moved too much. But interestingly enough, of course, as we just explained, earnings during the year went up 24%. So that means that relatively speaking, from the start of the year to the end of the year, the valuation for this company has gotten a lot better. However, of course, we can't just do a relative valuation because maybe it was overvalued at the start of the year and it's still overvalued. So what we need to do is we need to do an absolute valuation. We need to calculate how much cash we can get back from this company, and then we need to work out how much we're willing to pay for that cash. Now, I just want to be clear that this is not in any way a full valuation of Monster Beverage. The numbers that I'm using here are just an example of potential growth rates that you could use in your models. And if you want to apply this in your own analysis, then you need to thoroughly understand the business. You need to come up with your own estimates of how quickly they could grow earnings in the future. And then you could use some of the numbers that I use in this video to see what return you could get or where the stock price will likely be sort of in 10 years time. So just to do a quick valuation, we're going to use the earnings per share. We're going to grow it into the future. And then we're going to apply a PE ratio, a multiple that people are willing to pay on earnings, to work out what the price of this stock will be or likely be in 10 years time. And this is called the margin of safety method by Phil Town. EPS has grown at 19% over the past 10 years, which is an incredible growth rate. However, unfortunately, because they've grown so quickly, they've also attracted a lot of investors, and that is giving them a PE multiple at the current time of 40, which is really, really high. Over the next few weeks, I will be studying this company extensively, and I will be able to work out how much they could grow into the future fairly accurately. But for the time being, I can't make an accurate prediction of where their growth will be in the future because I haven't analyzed the industry thoroughly and I haven't analyzed their competition and some of the other factors that affect beverage businesses. So for now, we're going to use the value matrix where we can use a wide range of different growth rates and different PE ratios. And the growth rates that we're going to use are ranging from 5% all the way up to 17% per year for the next 10 years. As you can see, at the current stock price of about $63 per share, there isn't really a high return that we could expect to make unless they grow really, really quickly. So unless they grew at 17% per year for the next 10 years, and they also had a PE ratio of 25, so they currently have a 40, but I'm estimating that that's going to come down dramatically when their growth slows down. So even if they had a 25 PE and 17% growth per year, you would only make a 13% return, which is great, but it's not a big enough return that if they fall short, you will still make a good return. However, we can see that if we were able to get this stock at $30 per share, which would be a 50% discount, you can see that we would make a 15% return if they just grew at 11% and had a PE of 25. And that would mean that if they could eventually grow at 17%, then you would make 22%, which is 8 times your money over 10 years. So you can see that if we can wait and if we can buy this at a much cheaper price, then they don't need to grow as fast in order for us to make an excellent return. So I hope you guys enjoyed this one. And of course, I want to hear your thoughts on this company down in the comment section below. So drop a comment and I will be answering your questions after this video when it goes live. Leave a like if you enjoyed the video. But for now, guys, I'll see you in the next one.